Okay, good morning. So today we're going to be starting a new chapter. Before we get there, I'm going to talk about the exam, and we've got a question out there in Learning Catalytics. What type of account is accounts receivable? And the reason this is on my mind is now for the next several chapters, we're going to be working our way through the balance sheet. So the first chapters 1, 2, and 3 were introduction to here's transaction analysis, here's accrual entries, here's the type of accounts, here's the rules, debits, and credits. Even though our exams are not cumulative, everything else in the class builds on what we just did. So that debit credit handout remains useful. You still have to know what type of accounts things are. So this first question, what type of account is accounts receivable? It's going to be an asset, and the reason this is today is because this chapter is short-term investments and receivables. So we're starting kind of at the top of the balance sheet. Now, you notice that we skipped Chapter 4, and that was intentional because Chapter 4 is on cash and internal controls. And this Chapter 4, we cover it in one class day. And I really didn't want to do one day on Chapter 4 today, and then one day on Wednesday on Chapter 5, and then have homework due on 2 chapters, and then have Chapter 5 next week. So what we're doing is we're doing Chapter 5 this week, Chapter 6 next week, Chapter 7 the following week, and then when we get to Chapter 4, we're going to combine it with Chapter 8. They're both one-day chapters. So Chapter 4, we're getting back to it, but we are doing 5 this week, 6 next week, and 7 next week. So that's what's going on with that. This question will remain open for a little while. I'm not going to announce before I close it, but make sure you've got it answered. But what we have Chapter 5 homework due this weekend, and I'm going to talk about the exam now. First of all, the exam, the average was 72.1. If you would like to see a list of the exam scores, you can certainly do that. I made a list of the scores. I sorted them from high to low, and then beside each one I wrote a rank. There were something over 660 some students who took the exam, so I put a number beside each one. So if you go to tiny.cc/scores fall 2015, it is a PDF document. It'll open up, and you can see where your score falls. You can see what the scores were in the class. So there is that, okay? So when I looked at the scores, there were probably, I'm guessing, 6 or 7 people, if I recall, who got perfect scores. There were several people who got 98, 97, very high scores. Actually, so what I did yesterday morning then, in preparation for today, is I sent an email to people who scored in the top 10% on the exam. So I asked a couple questions in the email, but the one here is, what did you do to prepare for the exam? So I got responses back, and I wanted to share some of those with you. Now, if you wrote to me, thank you very much. What I'm going to be doing with all the responses I get as of the end of the day today for those top 10% people, I'm going to compile them all in a document. I'll put it on Blackboard so you can see all the responses. So I appreciate your responses if you shared that with me. Right now I'm just going to go through a couple of those. So again, I was asking people who scored the top 10% on the exam what they did. The biggest key to my success was just paying good attention during class and working through the problems with you during class. And then I wanted this. I am not an accounting major. I wanted to point out that the people that scored in the top 10% were by no means all accounting majors. There were some accounting majors in there, yes, but there were a diverse range of majors in there. So you don't need to be an accounting major to do well on the exam. Okay. This one I included an excerpt from it. Now remember, I asked this person how they did because they were in the top, how they prepared. They were in the top 10%. And they answered, I started your course last semester and ended up withdrawing when I realized I didn't have the time it takes to sit down and really learn the material. So this is a repeater. The person went on to say, so classes like this are always difficult for me. Numbers are scary. So this person went on to share in a longer, you'll see it in the excerpt, that they did the practice exam several times. In order to achieve the score in the exam, I took the practice exam 5 times. I went back and redid old homework problems. The practice exam is what helped me the most. I took my time on the first try. Then I took it a second time. I tried to only use my notes to help and then just continued to review. And that seemed to be a common theme. I did the practice exam all 5 times and then study plan on questions I wasn't sure of. Did the practice time 5 times. Now what I saw too with these people, and you'll see when I'm going to put all the people's responses who wrote to me in this document and share it. But a common theme was they took the practice exam with the study aids a couple times, and then they would take the practice exam without anything. One person, they started a couple days ahead of time and took the practice exam and then waited another day to take it. What I see sometimes when people don't do as well, I see them take the practice exam 5 times because they think, oh, I have to do it 5 times. So they'll take it and then 10 minutes later, 15 minutes later, take it again, 10 or 15 minutes later, and just do it in rapid succession. Simply doing it isn't going to prepare you. You kind of have to walk through it. You need to use it to prepare. Okay, so anyways, those are just some excerpts that I saw, and I'll share with you all of those, and I'll send it out via Blackboard tomorrow. So if you want to see specifically what you did wrong on the exam, there are 2 opportunities to do that. And that's with meeting with Amir. And Amir will be in room A230, which is a lab that it's on the 2nd floor of the College of Business. It's beyond the Proctor labs, but it's down the hall just on the very end. And he will be there from 1 to 4 today, and tomorrow 3 to 6. And I'm going to send this out this afternoon after I get back to my office after class, I'll send out a reminder about this too. So this is your opportunity if you want to go through your exam. And when you go in room A230, when you enter the room, it looks kind of like this. And assuming that the seats are not taken, he will position himself back kind of in that corner. Unless there's other people there, then he might be somewhere in there. But believe me, he will be there somewhere in that room. So that's room A230, and he will be there 1 to 4 today and 3 to 6 tomorrow. Now, that's your opportunity to go over your exam in detail. So you want to go see what you did wrong. That's when you see him. Now, if you want to talk about things, like you want to talk about you didn't do as well in the exam, you want to talk about anything with your performance in this class, come see me. I have office hours every Monday and Wednesday from 11 to 1:30. You do not need an appointment. You can just come. If someone's in there with me, just have a seat. There's a bench out in the hall outside my office, and I'll be with you. But I would love to see you, and I want to see you earlier as opposed to later. Don't wait to see me till the day before the next exam, because I'm less likely to be able to help you. I can help you now. So, and I'm going to send out, when I send out the excerpts of how students prepared, I'll just send out my observations about what I can see happening from an overall standpoint. But certainly love to talk to you about your particular situation. Do not hesitate to show up to see me to talk about your exam, but to actually go over the exam, to go into it, that would be Amir today or tomorrow. I just can't invite everyone to go over the exam with me because I simply don't have enough office hour time. So if you want to see your exam, go see Amir, and you want to talk in general about, we'll bring up your grades and we'll talk about your grades, but I'm not going to go over specific exam content with you. Okay, so, now the reason for this next question, I'm going to be putting up my next question that's coming. Okay, the next question is very focused, but what I'm trying to do is trying to make sure that the Wi-Fi, the reason for my next question has to do primarily with Wi-Fi on campus. Okay, but it doesn't matter. My next question, I'm going to be asking you, it's not out there yet. I want to explain why I'm doing this. Where were you when you took the exam? So obviously a lot of you are going to put computer lab in the College of Business. That's great. But a lot of you took it from your dorm room. If you took it from your dorm room, tell me dorm room where. If you took it from an apartment, tell me what street your apartment's on. What we're trying to do, this has to do mainly with ProctorU, looking for if there is spotty, they can tell your connection speed, and if we see in a dorm specifically that the connection speed is less than optimal, that will give me ammunition to talk to the university about upping the connection speed. But I need to know where you were, because what's going to happen is if you were taking the exam with ProctorU, I'll provide them this list and they can match it up to connection speed. So I'm just looking to improve connections, but I need to know where you were. So I'm going to send this question out now. So just give me specifics of where you were, okay? So wherever you were, tell me, and that's what I need here. Okay, great. Getting a lot of responses. Okay, you're going to have about 10 seconds left to get your answer in. Again, you have to answer to get credit. This one, obviously, I don't grade, but you get credit for this question regardless of what you answer, as long as it's a realistic answer. Okay, thank you on that. Any questions before we get going? Yes. The practice exam would only let you take it twice. You could email me at any time, but I mean, you would have to email me. But if you ever run into a problem like that, you need to email me right then. Okay. So again, any other questions? Okay, so we're going to be starting on the content for short-term investments and receivables. We're starting with investments, and what I want to show you right here is Coca-Cola Company. This is their 10K. Now, what's a 10K? If a company is publicly held, it has to file its financial statements on a quarterly and annual basis with the SEC, the Securities and Exchange Commission. So if you're publicly held doing business in the United States, you know, if you're part of the SEC, you file your statements. You file them at least quarterly and annually. Your annual filing is called your annual report, and the actual form it is the Form 10K. This is Coca-Cola's Form 10K. Every company that's publicly held has a Form 10K, and it's its financial statements that it submits to the SEC. So this is Coca-Cola's, and subsidiaries. That means all these subsidiaries that Coca-Cola has are included in this one balance sheet. Amazon has consolidated statements. All companies consolidate into one set of statements. So consolidated balance sheets, and we have always for the SEC, they require at least 2 years of balance sheets. There's requirements for how many years are presented. That's all governed by regulation. So this is 2 years for Coca-Cola, and this is just the assets. So your balance sheet's going to be your assets, your liabilities, and your stockholders' equity, but this is just the asset part of it. And up, the first thing you see is assets, and then current assets. And all current assets are going to be consumed or turned into cash within 12 months. So we see we're going to come back to cash in a later chapter, but we're talking about in this chapter short-term investments in marketable securities. That's what we're talking about. And then down below there where it says trade accounts receivable, that's what we'll be talking about on Wednesday. So that's where we are in the balance sheet. And just one quick trivia question before we get started. And again, give it your best shot, but you'll get credit for participating on this one. Name the one country where Coca-Cola is not sold. So just a little piece of trivia here. Put in a country name where you think Coca-Cola, the only country in the world where Coca-Cola is not sold. Yes. Doesn't matter. It doesn't matter if you enter it as one word or 2 words if you have a 2-word answer. Okay, about 10 seconds to get your answer in. Again, hazard a guess. This is one time where I'm going to say just guess. Okay, the answer is North Korea. There used to, recently, there were 2 countries. Cuba was the other one, but Cuba just signed a contract with Coca-Cola, so there's your trivia. North Korea is the only country in the entire world where you cannot buy Coca-Cola products. Okay, so what we're going to do now is we're going to start by talking about investments. Now, investments on the balance sheet under current investments are short-term investments are current assets, and there are 3 categories of investments in these short-term investments. There's trading, available for sale, and held to maturity. You need to know the 3 categories. So you will want to write the 3 categories down because you'll probably see this again, and maybe you see them soon. So trading securities are securities we're going to sell pretty quickly, soon, very soon. Available for sale means we might sell someday in the future. Held to maturity is a debt security that has a maturity date, and we're going to hold it till it matures. So we have 3 categories that can be in this general category. We're not going to get real deep in depth in this whole area, but we're going to hit the high points. We want to make sure at least we understand the vocabulary related to short-term investments and the basics behind them. Okay, so to illustrate this, I'm going to use an example where a company buys stock in another company. That could be a trading security. Trading securities are going to be where a company buys stock in another company, or a company buys a bond of another company. So a company has reasons to make short-term investments. Usually it's they have excess cash and they need to do something with it. So they're going to take it, go buy stock, just like you and I can go buy stock if we had excess cash. Companies can do the same thing. So 3 categories: trading, available for sale, and held to maturity. Okay, so let's go, there's some basics to do with this category. Let's suppose on June 18, 2014, Apple purchases 5,000 shares of Intel stock as a trading security. How do we know it's a trading security? We're told that it's a trading security. It's Apple's intent. Apple intends to sell this soon, so they classify it as a trading security. Suppose it's only short-term investment. It buys the Intel stock for $20 a share, paying $100,000 cash. So those are the facts. So when we record this investment, we're going to have an asset for $100,000 and credit cash for $100,000. That's it. So that's pretty straightforward. That fits with what we've done before. We buy the stock for $100,000, credit cash. Notice it's investment. We don't call it common stock. When Apple buys Intel stock, it calls it investment in securities or marketable securities or something like that. Whenever you see the word common stock as an account name, it refers to the equity of that company. So Apple has its own common stock, its equity. We're referring here, when they buy Intel stock, it's classified on the balance sheet as investment in or marketable security. So that's what happens when we buy it. Now, let's say on June 30th, when we buy equity securities, oftentimes there is cash dividends involved. Okay, so we might get dividends sent to us. So when we do that, we're going to have, we're going to debit cash and credit dividend revenue. Okay, so we've got cash coming in and dividend revenue. We're earning revenue. Okay, so we've got the purchase of the investment and we've got the cash dividend we can get. So now we're getting into another area of terminology, and this terminology, a very specific word here, is this word unrealized. Okay, unrealized is a very specific term. It means that we're still holding the securities. Unrealized means that it comes to the balance sheet date, our securities are worth more or less than what we initially paid for them, and we are reporting them at current market or fair value. So if fair value has increased, we have an unrealized gain. If fair value has decreased, we have an unrealized loss. Okay, so rewind to a couple weeks ago. We talked about in accounting, there's something called the historical cost principle. The historical cost principle states that we record things at their historic cost and we leave them at their historic cost. So if we buy a building, Scribbles building, whatever they paid for the building, that's what it's on its balance sheet as. It doesn't change value on the balance sheet. That applies to almost every account on the balance sheet, except for marketable securities or in these short-term investments. This is one of those exception areas. So what we do with marketable securities or trading securities is we revalue them at the balance sheet date, and we revalue them at their market value or their fair value. So sometimes you see current fair market value. I've got all the words there. Current value, fair value, market value. We go look up in the Wall Street Journal and see what the price is, and that's what we're going to value them at. We're going to value them at that current market value. So what we do is we say, what are they worth right now versus what were they worth when I bought them, or the carrying value. So if the fair value is more than what we paid, we have an unrealized gain. If the fair value is worth less than what I paid, we have an unrealized loss. The word unrealized, though, is huge. It means that we're still holding the securities. We have not actually experienced this gain or loss, but it's an adjustment to market value. So when you pick up any company's financial statement, you are going to see unrealized gains and losses. And that means that they're still holding it. This is one of those exceptions where we're adjusting things to market value. Okay, now, on the other hand, we have realized gains and losses. And realized, the word realized, typically realized has meaning to us, but it's not going to show. I'm going to cross this out only to say that we don't see the word realized. It's just gains or losses, but it means that we actually sold security. So if you see the word unrealized, it means we still are holding it. If you don't see the word realized, if it's just gain or loss, it's realized. It's implied that it's realized. And when we sell the investment, if the sales price is greater than the carrying amount, we have a realized gain. If the sales price is less than the carrying amount, we have a realized loss. Okay, so unrealized means we haven't sold it yet. If it says realized or doesn't say anything at all, we've sold it. So you're looking for the word unrealized. If you see it, we still own it. Otherwise, it's real. And the reason we're concerned with it is because if it's realized, it goes on the income statement as part of net income. If it's unrealized, it's a special category. Okay. So let's go through an example of this. Let's suppose that it sells its stock on June 19th for $107,000. Now note at the bottom, I've added a note. So if you have the PowerPoints, I added a note for this one. Assume that the carrying value of the stock is $105,000 prior to this sale. So we've got the stock valued at $105,000. Apple sells its Intel stock for $107,000. So what's happening there is they're getting cash for $107,000. They're going to credit their investment for $105,000 because that's what they've got on their books for. So the difference to make our debits equal our credits is $2,000, and that's going to be gain on sale of trading securities. So in the reason that says gain and not unrealized gain is because we've actually sold it. Now, I'm going back to Coca-Cola here in a minute, and what I'm going to do is I'm going to show you notes to their financial statements. Now, we haven't talked about this much, but companies issue their financial statements. Let's talk their 10K. So once a year, they're going to issue their balance sheet, their income statement, their statement of cash flows, and their stockholders' equity statement. They're going to issue that once a year. We're going to issue all the statements once a year, and that's part of their 10K. But there's an important part of the financial statements called the notes. The notes to the financial statement are just like what they found. They're long notes to help provide additional information than what's given in the financial statements. You cannot understand a set of financial statements without understanding what's in the notes, because the notes provide a lot of additional information. They provide a lot of interesting information. Now, in this case, I'm going to show you Coca-Cola's notes. Coca-Cola issued their balance sheet, which we saw earlier, and they have an investment note. They have note 3 for their financial statements is investments. And when we look at just picking out sentences in here, it tells us that their investments in debt and marketable securities are classified as trading, available for sale, or held to maturity. So those 3 categories of investments that we've talked about, we're seeing that explained in their notes. And then further down in their notes, it tells us that realized and unrealized gains and losses and realized gains and losses are included. It's telling you what they include in net income. And then it tells us how much unrealized gains they had. They had unrealized gains in 2013 and 12, and an unrealized loss in 2011. So they're saying, so we know by looking at that, seeing the word unrealized, that they were holding these at the end of the year, and this was the adjustment to market value that they had on their balance sheet. So the notes, we're going to see more notes as we go throughout the semester, but the notes can tell you a lot of information, and they're an integral part of the financial statements. So the financial statements are not the only things we look at. We also look at those notes. Okay, so now we have a question. It's a true-false question. Shouldn't be too hard. Short-term investments may be divided into held-to-maturity, trading, and available-for-sale securities. True or false? Go into Chrome. Log out and log back in. Okay. You can also do it on your phone. Safari. Safari doesn't play well with My Accounting Lab. Do you do your homework on it, and have you have your settings all set for it? Okay. There's the security setting in Safari. Or do you have Firefox? You can try that one too. Well, it looks like okay. About 10 seconds left to get your answer in. Okay, and that is true. Those are the three categories. Now, next up, an unrealized gain occurs when a company sells a trading security. Okay, an unrealized gain occurs when a company sells a trading security. True or false? About 10 seconds left to get your answer in. Remember what the word unrealized means. Right now, got a lot of wrong answers on this one. Unrealized means that the company still owns the securities. Okay, so unrealized means that the company still owns the securities. So okay, an unrealized gain occurs when a company sells as a trade security. Unrealized means that the security investment has not been sold yet, and this is market value. So that's what unrealized means. And then we have one more. A company will have an unrealized loss if the fair value of the investment is greater than its cost. So cost is what the company paid for it. Fair value is what it's worth right now. So cost is what the company originally paid for it. Fair value is what it's worth right now. Okay, a company will have an unrealized loss if the fair value of the investment is greater than its cost. That's going to be false. The reason it's going to be false is because we talk about the cost. So the cost is what the company spent for it originally, and now we're saying the fair value is greater than what we spent. If the fair value is greater than what we spent, then that means that we have an unrealized gain, not a loss. The cost is what we originally paid for it, so the current value, the fair value is what it's worth right now. So that one is false. Okay, now we're going to do a homework problem. We've got a couple of quick homework problems in this section. So this is one of them. And it tells us that Inverness Investments purchases DoorCorp shares as a trading security on December 16th for $85,000. So that's their original cost. They spent $85,000 in December. Suppose the DoorCorp shares decrease to $78,000 at December 31. Make the journal entry to adjust the investment account. So we went from 85 to 78. So we bought it at 85. It's fallen to 78, and we still own it. So that means two things to me. It's unrealized because we're still holding it, so that word unrealized needs to be in there. And the cost was 85. It's now worth 78, so that means a loss is involved because it's now worth less than what I paid for it. So when I'm doing the journal, I'm going to debit an unrealized loss because a loss works like an expense. For $7,000, I'm going to credit investment for the $7,000. The $85,000 minus the $78,000, that is not part of the journal entry. It's just showing you the computation where this came from. So this homework problem, you have to do the journal entry. So you're going to have an unrealized loss and credit investment. If it were a gain, by the way, if this investment were worth more than what I paid for it, then what you're going to have is you're going to debit the investment to increase it and credit unrealized gain. So just know that you can have a gain or a loss. If you're still holding it, the word unrealized needs to be in it. Okay, so the first requirement is to do that journal entry. That's all that's needed. The second entry is show how it would report the investment in trading securities. So this is Inverness, the company that bought the stock. So it bought the stock, so what it's going to show on the balance sheet is it's going to show an investment of $78,000. It's going to show it on the current assets. I know it's a trading security because they told me. It's the company's intent. The company buys this intending to sell it in the short term. So that's a trading, and they intend to trade it. On the income statement, an unrealized loss goes on the income statement under other revenues, and a loss, this is important, a loss gets parentheses around it, okay? If you don't have parentheses, it's a gain. So you need to make sure that this is one of those times that you put parentheses around it if it is indeed a loss. Okay, so now we're going to leave investments, and I wanted to go through investments so you recognize some of the terminology, know that companies do adjust some of those short-term investments to market value. It's one of the departures from historical cost principle, and now we move on to revenue recognition. The reason revenue recognition is important and why it's tossed in this chapter is we're about ready to get to receivables. Receivables, accounts receivable, are generated because we've sold merchandise to another business and they owe us. So this is when we're selling, or when we sell to customers and they owe us. That's what gives rise to receivables. So revenue is part of the receivables process. So the first thing we'll do is talk about proper revenue recognition. There's a lot of words on this slide, but basically we recognize revenue when the goods or services are transferred, when the other person owns the goods, when they're delivered, when we finish performing the service. That's the basic rule behind revenue recognition, regardless of all these terms that are up here. Price is fixed. Well, in our case, they're always going to give you the price. Collection reasonably assured. We usually don't sell to people if we don't think we're going to be able to collect. And if there's a lot of doubt about that, then this revenue recognition rules don't apply. So basically, we're going to recognize revenue when we deliver the goods or services. Now, so we're going to do a couple journal entries. And let's assume that Apple delivers a truckload of iPhones to AT&T. Okay, so we're just using really small numbers so it doesn't get out of hand. On the truck are 30,000 iPhones, each of which Apple sells to AT&T for $100 on account. So this is a basic sale journal entry. We're doing this from Apple's standpoint. So when Apple sells these phones, they have 30,000 of them at $100 each, $3 million. So they're going to have a receivable due from AT&T. So we have debit accounts receivable, credit sales revenue for $3 million. Oops. Okay. So that's a basic sales journal entry. That shouldn't be anything new from what we did before. So we've got the accounts receivable debit, the sales revenue credit. Now, moving forward then, we have something called shipping terms. Shipping terms govern when title changes hands and when we recognize revenue. The first one, FOB shipping point. FOB stands for free on board, but FOB shipping point means the title transfers at the point of shipping, where it's shipped from. So that means that the seller can recognize revenue when the goods leave their dock. FOB destination means that the title changes hands when it arrives. FOB shipping point, let me give you an example of FOB shipping point. If you order anything, let's say you make an order from LLB and they do not bill your credit card until they ship the merchandise. The day they ship the merchandise, they bill you and they recognize revenue. So they are shipping FOB shipping point. FOB destination would be if it ships FOB destination, title doesn't transfer until you get it. So that's a different set of circumstances. So you basically recognize revenue when the title transfers. So either at the destination or at the shipping point. So shipping point is at the seller's place of business, destination is at the buyer's. Okay, so when goods are shipped, FOB destination, revenue is recognized by the seller when the goods leave its shipping dock. True or false? FOB destination. When does the seller Okay, so goods are shipped FOB destination. Revenue is recognized by the seller when the goods leave its shipping dock. FOB destination means that title doesn't transfer until they get to the buyer. So when the goods get to the buyer, that's when title transfers, and that's when the revenue is recognized. So this is false, okay? Revenue is recognized when the items get to the buyer under FOB destination. Okay, more terminology. So we've got some terminology before we can actually get into receivables. Very specific terminology, just like unrealized has a very specific meaning for accounting. Sales discounts. Sales discounts refer to an early payment incentive. Sales discount does not mean you got a break on the price. A sales discount means that there was a discount offered for early payment. Typical incentive, how you would say this, what's in the box on the screen, is 210 net 30. 210 net 30. What the 210 means is that there's a 2% discount if paid within 10 days. That could be 110. If it were 110, it would be 1% discount within 10 days. It could be 115, which is a 1% discount within 15 days. So that's the discount terms. The second part of this, the net 30, that means the full amount is due in 30 days. So if you don't take the discount, you have to pay it within 30 days. So businesses do this as a way to speed up their cash flow. So if their customers pay faster, the businesses can use the cash to pay their own suppliers, to pay their employees, and they can use cash is usually tight in businesses, so they will offer payment incentives as a way to speed up the cash flow. Okay, now the accounting for this is, let's say discounts offered for early payment. Back to our Apple example, let's assume that they're using 210 net 30. So the discount for Apple, for AT&T, if they pay within the 10-day discount period, it's going to be 2% of $3 million. So you can calculate the discount is 2% of $3 million, it's $60,000. So when AT&T pays Apple, so let's assume that AT&T pays within the 10 days. What AT&T is going to do is AT&T is going to pay cash. And the amount of cash AT&T is going to pay is going to be $2,940,000, which is the $3 million invoice less the $60,000 early payment discount. So they're going to pay cash of $2,940,000. So Apple's getting that amount. Now, if I were writing this journal entry, I would skip a line, and then I would do my credit, but leave a blank line. I would skip a line, and I would do a credit, and I'm going to credit accounts receivable. Remember, this is Apple. AT&T just paid their entire invoice. They took a discount, which we allowed because we offered. We're Apple, and we offered early payment discount. So, but when AT&T pays the invoice, they're paying the full amount. They're paying everything off. So Apple needs to credit accounts receivable for $3 million because AT&T doesn't owe anything anymore. So we're going to see a credit for $3 million. So then the difference between the two, our debits have to equal our credits. The difference, the $60,000, is going to be debited to sales discount. Okay? So if I were figuring this out on my own, I would do the cash debit. I would do the accounts receivable credit for the full amount, and then the difference is that discount, and it goes to an account called sales discount. Okay, so that's a sales discount. A sales discount has to do with early payment. Now next up, we've got some more terminology, sales returns and allowances. Sales returns and allowances, there's something wrong. People want to return the merchandise or get a credit for it. Let's say of the 30,000 iPhones Apple sells to AT&T, 100 are returned because they're damaged in shipment. So when AT&T returns the 100 phones, what we're going to do is Apple's going to debit an account called sales returns and allowances and going to credit accounts receivable. So they're writing off that amount. Companies are going to do this when merchandise is returned to them. They're also going to do this when something's damaged and they offer the customer some credit. My son got a refrigerator from H.H. Gregg, and when they delivered it, there was a dent in the door. And H.H. Gregg offered to take back the refrigerator or give him $100. And so that $100 they offered him, that would be a sales allowance. So that's what those are. Sales returns, they give it back, they return it. Sales allowances, there's some credit given, some reduction of the invoice due to damage. Okay? Sales discounts, early payment. None of these terms refer to, oh, we're going to have a sale and offer everything 25% off. That doesn't, we don't record that separately. We record it at the selling price, whatever we sell it at. But we have sales returns, customers return things, sales allowances, something's wrong, we give the customer some money to compensate, and then sales discounts, which are early payment related. Okay, so short exercise 5.5. This is in your homework. You actually have 4 and 5, so we're going to tackle both of them right now. We have a manufacturer, Patrick Sports, sells a truckload of sporting goods to Sports R Us. The terms of sale are FOB destination, so that's important, FOB destination. The truck runs into bad weather and doesn't arrive till January 2nd. The invoice is $308,000. The company's year end is December 31st. So for exercise 5.4, it's asking what would Patrick Sports reflect on its 2014 income statement. It's going to reflect 0 for sales for this transaction because it doesn't arrive till January 2nd. It's FOB destination, so it is not sold until it reaches the destination. Okay, so that's 5.4. But 5.5 says the sales term on the invoice are 210 net 30. What does it mean? What are their savings? So what does that mean, 210 net 30? It means that Sports R Us will get a 2% discount if it pays the invoice within 10 days. Otherwise, the whole amount is due within 30 days. Okay, so that's what the 210 net 30 means. Okay, and then what is Sports R Us potential savings? Well, it's 2% of the invoice, so 2% of $308,000. That 2% of $308,000 is $6,160. Another way to look at it is what's the net amount of the invoice. You can take 100% minus the discount, so you can take 98% of the $308 to get what they will owe. Okay, so those are 2 really quick exercises, 2 or 3 that we just did that are on the homework. And I have a question now, please. Oh, how much time does the company have to take? 10 days for the discount, 30 for total. Okay. Okay, so question 13. Okay, business offers credit terms 115 net 30. What do these terms indicate? Read carefully. Make your selection. Okay, business offers credit terms of 115 net 30. 115 means that you will get a 1% discount if you pay it within 15 days, period. The net 30 means that if you don't pay within the 15 days, you have to pay it within the 30 regardless. So what you're going to see on this one is the answer is going to be B, a discount of 1% can be taken if the invoice is paid within 15 days. If the answer is not C, you have to, C is not right because you don't get the discount if you pay in 30 days. You only get the discount if you pay within the 15 days. Okay, now, okay, so I've gone 4 weeks of this class. I run late every day, right? So what time is it? So today I'm like, I'm going to get you out on time. We're out, what, 17 minutes early? Believe it or not, is that okay? Or you want me to keep talking? Okay. 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 Remember, you can see your exam today 1 to 4 or Tuesday 3 to 6, and I will see you on Wednesday.